welcome. You're watching Bloomberg Quint. Well, it's not been a great week, or rather last 1 month for the Indian markets. $200 billion have been wiped out of Indian equities since Modi government's budget on the 5th of July. And that's, by the way, 14 lakh crore of investor wealth lost. Foreign investors alone pulled out more than $2 billion in July. So what's caused the sudden change in market sentiment? Is it the tax changes, lack of growth stimulus, or higher valuations? Or is it completely a global phenomena, Fed commentary, trade war, or the geopolitical tensions? Perhaps the questions are many, so let's find out what's plaguing the Indian markets from Guy Stear, Head of Emerging Markets and Credit Research at Societe Generale. Hi, Guy. Thanks a lot for joining us today on Bloomberg Quint. My first question has to be, what is the reason for the underperformance of Indian markets compared to the global markets since the time the union budget came out on 5th of July? FIIs have been selling out here. So far, the reasons being cited for higher valuations or economic slowdown, liquidity crisis, but we were still receiving FI money that time.
Well, I think, as you mentioned, the markets more globally have been challenged. And I think one of the things we have to recognize is that India has been something of a success story for the past couple of years. So when you look across emerging markets more broadly, there have been a lot of people who were long the Indian market. As a result, one of the big concerns that people have is, how do emerging markets deal with a world of more trade wars and a world which has up till now been really characterized by dollar strength? So money has tended to come out of emerging markets, and I think in a sense that's disproportionately hurt India because there has been more money to come out of India than elsewhere.
So, Guy, what you're proposing is the outflow is actually not India specific, but it's emerging markets as a whole, because one is now looking at more money flowing into developed markets like America. It's nothing got to do with the higher surcharge being announced for the FPI community in the new union budget in India?
Well, I think there are, as you mentioned, there are some India-specific issues as well. I think on the margins, there's probably a little bit of disappointment with the way that the budget has been set up and the surcharge that you mentioned. But I think that normally would have prompted a correction, and then we would normally see a market which is still holding up fairly well. I think there are many, many bigger questions being asked about emerging markets at the moment. I mean, one of the things that we've seen this week has been generalized weakness in terms of emerging market currencies. We've seen that particularly in terms of the Chinese currency, the CNY, over the past 48 hours. And in a sense, where China leads, other emerging markets follow. India has been one of the big emerging markets where you have plenty of different types of opportunities in which to put money. And so I think that now India is suffering disproportionately from those money flows coming out of emerging markets as an asset class.
Okay, Guy, before I move ahead and take more perspective on the other markets, just one thing, since you interact with a lot of FIIs and the community who invest into the Indian markets, is there any concern that they've been highlighting on this higher surcharge issue? Also, the finance minister proposing that the FIIs who are registered as trust have an option to convert themselves into corporate. How feasible is that an option?
Well, I think that there's a little bit of confusion, as you mentioned, about what the options are and what the future will bring in terms of the way that the market will work structurally. And I think until those problems are resolved, that confusion is going to persist a little bit. So, as you mentioned, it is a factor which is on the margins, certainly, and maybe more than on the margins, weighing on the Indian market.
Okay, and you also highlighted that the money is flowing out of emerging markets, but are you also seeing trends, because certain reports are now indicating how China is opening up to the foreign money and the money is actually flowing into China within that basket?
Well, you have a combination of the two factors. One is you have some Chinese easing of regulations, Chinese bonds entering indices. These factors are tending to lead to some broader rebalancing in terms of China. That's a structural story. I think the cyclical story is how will emerging markets as a whole cope with Donald Trump's trade wars? How long are the trade wars going to last? Are they going to continue to get worse? And certainly that's the sentiment we've had over the past 24 hours. What's the prospect for the currency? Is there a chance that Donald Trump could start intervening to drive the dollar lower? If that were to be the case, I think people would get even more concerned about emerging markets over the sort of 3 to 6 month time frame, because we're not only dealing with a world with slower growth because it's less efficient in terms of fewer trade flows, but also in a more uncertain world when we start talking about currency intervention.
So where is the money flowing in right now, Guy? Is it the developed markets, and which are the asset classes where you're seeing more money being deployed now?
Well, in developed markets in particular, I think you're right to say that broadly across the emerging market spheres, we're seeing money coming back to developed markets. Where it's going in developed markets is areas where yields are reasonably high. There's no such thing as a high yield anymore in this day and age, but where real yields are reasonably high. What we've been seeing is money flowing into, for example, high yield corporate bonds, particularly in Europe. The property markets continue to see a lot of money being invested in real estate broadly. That's true on both sides of the Atlantic. Commodities are one area where people are putting the money to work because they're saying if currencies are continuing to weaken, commodities such as gold, but also metals, also energy, these are areas that can do reasonably well. So that's where the money is tending to flow at the moment.
And looking at the larger picture, do you think that phenomena of outflow from the EMs, if that continues even in the second half of this year, outperformance from developed markets will continue and the EMs will continue to underperform?
Well, I think two things will happen in the emerging markets. The first is that the currencies will continue to be relatively weak, and I think that's going to be much more of a driver. Particularly if we were to see the CNY break above the 7 level, people would get very concerned about the emerging market currency complex as a whole. At the same time, when it comes to domestic bonds in emerging markets, they're probably going to be following the downward trend of developed market bonds. There'll be a little bit of two influences on the market. On the one hand, global interest rates are continuing to come down. But on the other hand, you're going to need a little bit of a premium in terms of to offset currency losses. So I do think that through the summer and well into the beginning at least of the fourth quarter, we're probably in for a period of emerging market underperformance generally against developed markets.
Well, and the talks of a trade war are back this week, with Donald Trump now announcing that he will be levying additional tariff of 10% on goods worth $300 billion. What sort of collateral damage do you see emerging markets can have on back of this move?
Well, the first thing is weaker growth expectations. That'll particularly hit China, but China is so important in terms of emerging market growth more broadly for all of Asia, for all of Africa, for Latin America too, that where China goes, other emerging markets may well follow. So I do think that there'll be more concerns about growth in emerging markets as a result of these tariffs. And I think that's really going to be the dampener which will affect markets for the next couple of months.
Little money, whichever is flowing into emerging markets, in your pecking order, which are the preferred markets right now?
I'm sorry, I missed the end of that question. Can you repeat it, please?
I was asking money which is flowing into emerging market equities right now. What is your pecking order? Where do you see money flowing into? Which are the markets right now which are still looking attractive in the EM basket?
So I think probably equities are best because you will have a little bit more potential in terms of the medium-term growth story. I would actually say that domestic fixed income, particularly with an FX hedge, would be probably the most attractive asset class across emerging markets. Then hard currency emerging market bonds would probably be reasonably good, but I would stick with sovereign hard currency bonds rather than corporate hard currency bonds. I'd have a tendency to favor areas where they are more commodity based, so that will probably favor Latin America versus other areas of emerging markets just at the moment. And I think Asia will be very much tied to the fortunes of China.
Okay, so what about India? Do we expect more outflow from the FI community in the second half of this calendar year?
I think the big question for India is how sensitive are they going to be to the China story more broadly? I mean, I think they're going to be less sensitive than North Asia in general, less sensitive a little bit than Southeast Asia. They do tend to be one of the most independent parts of the Asian complex. But I do have a feeling that I think the Indian market will have a tendency to be dragged in the direction of the Chinese market as well. So I think that over the next couple of months, I would still be relatively cautious in terms of the Indian market.
Okay, before I thank you, Guy, anything that you or the entire FI community is looking to hear from the Indian policy makers?
Well, I think clarity in terms of, as you mentioned, in terms of some of these the surcharge and some of the policy and some of the different options that can be taken. And then I think to get a broader sense of how independent Indian growth is from what's going on in the rest of the world, that would also be helpful. That's not something we can necessarily rely on the policymakers for, but we'll see it in the data.
All right, Guy, we'll leave it at that note. Appreciate you joining us today and taking us through your views on the global market, especially what can outperform.
Thank you for inviting me.
Thank you. In the second half, well, that's Guy Stear of Societe Generale, clearly stating that he expects outperformance from the developed markets vis-a-vis the emerging markets in the second half. Thanks a lot for watching.